Welcome to the Deconstructionist Deep Dive.
The podcast that doesn't just accept the story.
We break it,
We examine the pieces.
then expose the machinery inside. Let's dive in.
Today we are asking, what if the promise of wealth without risk isn't just too good to be true, but is designed to be too good to be true?
Right. We're diving into a really fascinating structural analysis today, looking at these persuasive investment claims. And we're using this cathedral of thought framework based on the material you shared with us.
Yeah, it's a powerful metaphor.
It really is.
Yeah.
And our goal isn't just to, criticize the advice itself. It's more about equipping you, the listener, with the tools, the knowledge to actually see the hidden architecture behind these often high-pressure sales pitches.
Exactly.
Our mission really is to dismantle piece by piece this incredibly dangerous illusion. The idea that you can generate significant wealth without taking on proportional quantifiable risk.
Especially in something as inherently complicated as tax-defaulted property investing.
Yeah.
It's just not simple.
Not at all.
And that cathedral metaphor, it's so important for understanding the strategy here. Because these pitches, they aren't just random claims thrown together.
No, they're engineered.
Meticulously engineered, beautiful structures almost, designed specifically to get that immediate emotional buy-in.
Right, to bypass the slow, careful, logical part of your brain.
Precisely. So we're going to trace the blueprint, look at the visible supports the claims they make openly.
Then we'll analyze the shimmering, decorative stuff,
Yeah.
the emotional engineering.
Yeah, the stories, the authority figures.
And then, crucially, we're going to expose the crypts, the things they deliberately bury.
The complex legal stuff, the financial realities, all the things they don't want you thinking about because it undermines the whole illusion of simplicity.
Okay, let's start right at the bottom, the foundation. Every cathedral, every big structure needs a foundation, right? An assumption so strong, maybe so appealing that people just accept it, like an axiom.
A given truth.
And here, the core assumption they build everything on is this. Tax-defaulted property investing is supposedly universally accessible. Anyone can do it. It's low risk. And it's a high-return way to generate wealth.
Basically a cheat code for real estate investing. That's the hook.
Exactly. But that foundation, which looks so solid, it's actually built on some really dangerous implied axioms, beliefs you take on board without even realizing it.
Right. If you buy the main slogan, wealth without risk, you automatically sign up for these silent assumptions. And they're destructive.
Okay, the first one. Due diligence is minimal. They have to convince you of this.
Why?
Because the hard work in real estate, the technical stuff, the legal checks, title searches, that takes time, effort, money. It involves lawyers, title companies. If you knew that, the easy wealth promise falls apart.
So they downplay it, make it sound like a quick look is enough.
Yeah, the pitch implies this casual drive-by and look inspection is all you need to secure potentially massive profits, which is, well, it's catastrophic thinking.
Especially when you consider why these properties are available. The government has flagged them for non-payment.
Right. That's a huge red flag in itself. The likelihood of hidden problems, hidden liabilities, it just skyrockets. But they suggest you don't need to worry too much about that.
Okay, so that's axiom one. Minimal due diligence. What's the second?
The second, implied axiom. Competition is easily manageable. They paint this picture of you operating in some quiet, undiscovered niche.
Like, you're the only one who's found this secret gold mine.
Exactly. Because think about it, if the competition was actually fierce, if experienced investors were flooding these auctions,
The margins would disappear, the potential for easy profit evaporates.
so they have to downplay the reality, the often adversarial nature of the auction environment. They suggest you can just stroll in and pick up bargains.
Which ignores the fact that other people are there, likely with more experience and capital.
Precisely. Okay, and the third axiom, maybe the most naive one,
Let's hear it.
that all this regulatory complexity, tax law, foreclosure law, local ordinances, is easily navigable by a complete novice.
Oh, just using their prepackaged webinar system, right?
You got it.
Sure.
Despite the fact that this stuff is notoriously intricate, it changes constantly. It varies wildly from place to place. Yet the pitch insists you can master it all without a law degree, without specialized local help. Just buy their course.
That's a big leap of faith.
It's huge. And the danger for you, the listener, is how that core assumption, low risk, starts to creep. Once you accept that, you stop asking the hard questions.
You stop asking about title defects, Environmental hazards,
Yeah.
zoning issues, because you've already accepted it's low risk.
Yeah, the critical thinking gets shut down early.
And look at how they handle time, the
Yeah.
temporal context. They position this opportunity as, like, timeless, like it's a fundamental law of finance that will always work.
Right, an everlasting strategy. But that completely ignores the reality
Which is,
that it's totally dependent on constantly shifting jurisdiction-specific laws, things that vary county by county, state by state. And it depends on local market conditions, which are cyclical.
so what supposedly works great today in, say, one county in Georgia?
Might be instantly useless next year. A court ruling changes, the state legislature tweaks a law, the local market tanks, and the timeless strategy breaks down.
You know, a truly timeless investment strategy, maybe like buying and holding broadly diversified index funds, doesn't hinge on the specific redemption period set by a single county ordinance in Georgia.
Good point.
If your entire profit model relies on successfully navigating some archaic, hyper-local legal code, well, that's the exact opposite of a robust permanent strategy, isn't it? It's incredibly fragile.
Absolutely. It's built on shifting sands, not bedrock. Okay, so that's the shaky foundation. Now let's look at the pillars holding up this cathedral, the main claims. The first pillar, and maybe the most seductive one, is the guaranteed return argument.
Ah, yes, the magic numbers.
They cite specific statutory returns, like they'll point to Georgia redeemable tax deeds, promising 20% in the first year, and then a massive 30% in the second year.
And they frame this mathematically, making it sound so clear, so simple.
Exactly. The narrative is, you invest, say, $200,000, your worst case, absolutely guaranteed return is $40,000 after 2 years.
Wow. That sounds safer than a government bond, but with exponential yields.
Right. It seems fixed. Simple. And because it's based on a state statute, it gets this air of government authority, like it's officially backed.
Okay, but you used the word seductive. Where's the catch? There has to be a critical omission here.
There is a huge one. It's the rot hidden inside the concrete pillar. That statutory rate, the 20% or 30%, it's entirely dependent on external factors you cannot control.
Such as?
Specifically the redemption process, which is handled by the local municipalities, often slowly and inefficiently. And it depends entirely on the unpredictable behavior of the original property owner, the one who couldn't pay their taxes in the first place.
This is where we need that technical distinction, isn't it? Between the rate and the reality.
Yes. You might have a guaranteed rate of return if redemption happens, but you have absolutely no guarantee of liquidity, no guarantee of when or if you get your money back.
So the state guarantees that if, and only if, the owner eventually scrapes together the money and redeems their property, then you get that statutory interest rate on your investment.
Correct. But what if the owner never redeems, which happens a lot?
Then what?
Then you're left holding a tax deed, which isn't clear title to the property yet. You now have to initiate a costly, complicated legal action, either a foreclosure or something called a quiet title action, just to get clear ownership so you can actually sell it.
Ah, so that guaranteed $40,000 return on your $200K.
Could instantly get eaten up.
Yeah.
Maybe $15,000 in attorney fees, $5,000 holding costs, property taxes keep coming, insurance, and you might wait 3 years just to get through the legal process.
So the rate was guaranteed on paper, but the actual net profit, the timing, the sheer effort involved, totally uncertain.
Completely uncertain. You've essentially traded your liquid cash for a highly illiquid, time-locked legal instrument.
It flips instantly from guaranteed profit in the pitch
to guaranteed legal complexity in reality.
Okay, so the guaranteed return is the hook. What's the next pillar?
If the guarantee draws people in, the next pillar keeps them there by emphasizing the sheer scale of the opportunity. Pillar number 2, the abundance argument.
Right, the too big to fail idea applied to opportunity.
They throw out huge numbers, massive quantitative claims, to create this feeling of infinite possibility.
Like what sort of numbers?
Oh, 1,100 plus properties available every month in just one county like Tulsa. Or they'll say, think about it, 159 counties in Georgia, each holding monthly auctions. They multiply it out to sound astronomical.
And the implied messages.
This market is so vast, you don't have to worry about competition. You don't have to fight for scraps. Success is easy, repeatable. Just dip your bucket in the ocean.
The same source material we looked at gives a reality check, doesn't it?
It does. That theoretical abundance just crashes headfirst into the reality on the ground. The material mentions 400 or more attendees often showing up to these auctions.
400 people for one auction.
Sometimes, leading to maybe 150 or more active bidders competing at a single event.
Okay, that sounds less like abundance and more like Intense competition.
It's a classic bait and switch using numbers.
Right.
You have an abundance of raw inventory. Yes, those 1,100 properties.
But what's in that inventory?
Everything. Parcels with unusable titles, properties with hidden environmental hazards, landlocked parcels with no access, buildings with catastrophic structural damage. Junk, basically, most of it.
So when you have 150 experienced bidders,
They're all laser-focused on the maybe one or two genuinely clean, valuable assets in that pile of 1,100.
and suddenly it's not abundance, it's intense scarcity for the quality stuff.
Crushing competition for the few good deals. It becomes an information asymmetry trap.
Yeah.
The novice investor, who got the abundance pitch, sees 1,100 options and feels overwhelmed but optimistic. The expert bidders, they instantly filter that down to maybe 0.5% worth actually fighting for. They know what to look for, what to avoid.
And that leads to bidding wars.
Exactly. Bidding wars that push the acquisition price way up, often beyond the point where that advertised 20% statutory return is even mathematically possible after costs.
So the abundance is just cover for brutal competition on the assets that actually matter.
Precisely. Okay, pillar 3. If the returns are iffy and the competition is fierce, how do they keep you going? By outsourcing the complexity. The extant guidance argument.
The coaching system, the gurus.
Right. The pitch centers heavily on a coach-based learning system. They use figures like Bob Shoemaker, someone touted for 15-plus years of experience, 150-plus deals under his belt.
Building credibility through claimed experience.
And they advertise this clean, structured mentorship pathway. Watch our webinars. Let us review properties with you. We'll guide you through auction participation.
It sounds like a beautifully simple, linear map to success. Just follow the steps laid out by the expert.
Follow the recipe. But there's a critical flaw here, an unstated dependency.
Which is?
Your success is made entirely contingent on accessing their paid coaching ecosystem.
So the system isn't just selling wealth generation, it's selling education. It's selling ongoing mentorship.
Exactly. And what's fascinating, or maybe alarming, is that this means the promoter's primary profit stream relies on continuous enrollment. They need you to keep paying for the guidance.
Think about the incentives there. The system cannot be truly simple and transferable.
Why not?
Because if they actually created a simple system that made lots of people independently wealthy and successful on their own,
their own educational market would dry up. They'd have no one left to coach.
Exactly. So their incentive is to maintain the perception that the market is accessible, yes, but only through their proprietary, costly, ongoing guidance.
So the very complexity they claim their system solves
is actually the mechanism that sustains their business model. They need it to seem hard enough that you need them, but not so hard that you get up entirely.
Wow. Okay, that leads directly into the final pillar, which feels the most psychologically manipulative.
The psychological barrier argument.
Yes. This is where they systematically reframe legitimate investment complexity, real risks, as personal development flaws, character defects in you.
How does that work? Give me an example.
The material we reviewed mentions Alex Mandossian's failure triad: procrastination, perfectionism, and loss of momentum.
Okay.
This is masterful emotional manipulation because it shifts the blame, the locus of failure, entirely onto the investor's character.
So instead of acknowledging that, say, uncovering hidden liens or title defects is genuinely complex and requires careful work.
They tell you your perfectionism is holding you back. You're overthinking it. Just act.
Or instead of admitting that the process of filing for foreclosure if the owner doesn't redeem is financially draining, time-consuming, and legally daunting.
They label your hesitation as procrastination. You're just putting off success. You lack momentum.
Wow. So real risks get turned into personal failings.
And they reinforce this using a really strong, binary, almost shaming narrative. It's unsubtle.
Oh, so?
They paint the investment path they're selling as freedom. They align it with rugged capitalism, true entrepreneurship, taking action, winning.
And the alternative
is framed as socialism, or just, boring traditional employment, playing it safe, being a wage slave.
So if you express caution, if you ask for documents, if you pause to think critically,
you're implicitly choosing the wrong side. You're proving you lack the necessary hustle, the entrepreneurial spirit required for this kind of success. They make you feel ashamed for being careful.
They weaponize your own desire for independence and financial freedom against you.
Precisely. They make rational caution feel like a moral failing. And that is how they solidify the whole shaky foundation. By ensuring that if things go wrong, the investor accepts personal responsibility for market risk they were never even properly warned about.
Okay, so we've got the structural framework mapped out. the shaky foundation, the deceptive load-bearing pillars. Now let's talk about the decorations.
The aesthetics of the cathedral.
Exactly. This is the psychological scaffolding. The stuff that makes the whole structure look irresistible. The elements designed to distract your eye from the weak supports underneath.
Right. The emotional engineering, hashtag 2.1, the power of curated narratives, survivorship bias. And a huge part of that is storytelling. The pitch relies almost entirely on vivid, anecdotal success vignettes, presented as proof.
These are the glittering gold leaf covering the cracking concrete, aren't they?
Right.
Designed to appeal directly to your aspirations, not your calculator.
And they make them incredibly specific, which helps them stick in your mind. Let's detail some of the claims mentioned in the material.
Okay.
There's Jeff Dubet, claiming he turned $200,000 into $40,000 profit in just 9 months, operating in Florida and Georgia.
Okay, that's specific. $200K to $40K in 9 months. That's a 20% return, achieved quickly on a substantial chunk of capital.
Right. The message to the listener is clear. This isn't just possible. It's fast, even with big money.
Then you often get the contrast, the low-entry example.
Exactly, like B.R. Baker, turning a tiny $1,800 property into $500 per month in rental income.
Ah, the appeal to the smaller investor. That story targets the person thinking, I don't have $200,000. It convinces them that even tiny capital can supposedly lead to significant passive income really quickly.
Makes it seem accessible to everyone. And then, for the wow factor, the expert validation.
You get stories like the one about Coach Bill.
Yeah, claiming he acquired 31 properties at a single auction, sometimes paying only $800 for lots that were supposedly in a $150,000 neighborhood.
Okay, that generates awe. It creates this sense that the opportunity is so incredibly undervalued, you can literally buy assets for pennies on the dollar if you just have the right insider knowledge. Their knowledge, presumably.
But here's the massive hole in all of this, the verification gap.
No proof.
These anecdotes are presented completely without documentary evidence. No copies of tax records are shown, no final deeds proving ownership transfer and price, no public performance audits detailing the actual holding period, the legal costs incurred, the repair costs. Nothing verifiable.
They are exclusively success stories, hand-picked, which screams
Extreme survivorship bias.
yeah. It's like showing you only the lottery winners. When you see Jeff Dubet or B.R. Baker presented as typical outcomes,
You're led to believe the odds are heavily in your favor, but they deliberately omit the other side.
what's the failure rate? What's the median performance data for the average person who pays the coaching fees and tries this?
We don't know. They don't tell you. If, say, 99% of participants actually lose money or barely break even because the complexity overwhelms them, but you only ever hear about the 1% outlier who struck gold.
Then the entire market looks incredibly promising and low risk, even if it's actually a minefield.
If they genuinely had a transparent, statistically validated process that worked reliably.
They'd lead with the aggregate data, they'd show the median returns, the standard deviation, the average holding period, proof of repeatability.
Instead, they lead with the unverifiable, exceptional outlier, which effectively turns what should be a rigorous financial decision.
Into a hopeful aspiration. A gamble disguised as a system. Hashtag 2.2 authority and credibility substitutes. Okay, so you have these dazzling, unverified stories. But stories alone might not be enough. The architecture needs weight. It needs borrowed authority.
Right. Credibility substitutes. They use celebrity association aggressively. It's an emotional shortcut to trust.
Give me an example from the material.
Look at the claimed links for figures like Alex Mandossian. The material mentions name-dropping Richard Branson, Tony Robbins, even the Dalai Lama.
Okay, wait. Richard Branson, Tony Robbins. What do they have to do with navigating municipal tax code in Georgia? Or understanding foreclosure law in Florida?
Absolutely nothing. Zero substantive connection. But their names carry weight. They act as emotional shortcuts. It's pure rhetoric.
If someone I trust, or someone rich and famous, seems to endorse this speaker,
Then maybe I don't need to do my own homework. I can skip the hard verification process because these important people implicitly vouch for them.
it's the sheer weight of external, often totally unrelated, authority figures, deployed specifically to validate this particular investment strategy.
And its main function is distraction. It distracts you, the learner, from conducting your own substantive, difficult analysis. The analysis of property title, lien priority, legal risk, the stuff that actually matters.
And this gets reinforced internally too, right? By creating your own authority figures.
Yes. Positioning people like, say, Ted Thomas as America's tax lien certificate and tax deed authority.
That title sounds impressive. Authority.
It centralizes knowledge.
Mm.
It suggests that the real expertise is proprietary. It's available only through their specific system, which implies that any dissenting voices, anyone urging caution.
They're just uninformed outsiders. They don't have access to the special knowledge.
The goal here isn't to build your competence, it's to build your confidence.
Confidence in them.
Exactly. By substituting borrowed or manufactured authority for genuine, verifiable expertise, they give the investor the feeling of being protected, the feeling of being well-informed.
Without actually requiring them to achieve the difficult, time-consuming competence needed to genuinely manage the risks involved. It's a dangerous illusion of safety. Hashtag tag 2.3 psychological exploitation mechanisms.
Okay, let's get into the mechanics. How does this psychological scaffolding actually work to shut down skepticism? The material outlines Mandossian's technique of objection preemption.
Preempting objections, how?
Through emotional narratives. Seeding stories specifically designed to cut off rational objections before they even fully form in your mind.
This sounds like, well, like psychological warfare, almost, applied to sales.
It kind of is. Take this snooze button story that was mentioned.
Okay, the snooze button.
This story frames any initial hesitation, maybe wanting to do more due diligence, asking for clarification, simple caution, all essential parts of sound investing.
It frames them as what?
As a personal character flaw. Laziness, lack of drive, hitting the snooze button on your life, on your potential success.
Wow. So if I pause and say, hang on, I need to check the title insurance policy details, or I should probably consult a local attorney about this county's specific rules.
The narrative implies you're just being a procrastinator. The successful entrepreneur acts fast. They don't get bogged down in details. They imply that careful analysis is actually a sign of weakness. They force action by moralizing momentum.
That's potent. And they set unrealistic standards too, right? With stories about the promoters themselves.
Yes, the hospital teleseminar story. The promoter supposedly working, closing deals from a hospital bed.
What's the point of that story?
It's designed to normalize extreme sacrifice. Burnout becomes a badge of honor. It sets this incredibly high, frankly unhealthy standard for commitment.
So if you're sitting comfortably at home, maybe with your family, and you hesitate to pull the trigger on some complex, high-risk deal you don't fully understand.
This story subtly shames you. It suggests you just don't want wealth badly enough. Not like the guru who sacrificed his health for it. Are you really committed?
It makes reasonable boundaries seem like lack of ambition.
But the core function, the linchpin of this entire psychological scaffolding, is risk transference.
Okay, define that.
This is the ultimate, most insidious strategy. They systematically reposition tangible, structural, real-world investment risks.
Like poor title, environmental contamination, costly foreclosure fights.
Yes, all those things. They reposition them as purely psychological hurdles, problems that only the uncommitted, the weak-willed, the procrastinators face.
Can you give a clear example of how that plays out?
Yeah.
Based on what you shared?
Sure. Let's say an investor follows the system, buys a property, and then loses $30,000 because, oops, there was an unexpected superior IRS line they didn't know about. That's a verifiable material risk that proper due diligence should have caught.
Okay, a real financial loss due to a structural issue with the deal. What does the coaching system say?
The coaching system doesn't say, our due diligence checklist was flawed, or we should have warned you more strongly about checking federal license.
Yeah.
No.
They say.
They tell the investor they lacked the necessary momentum. They didn't have the right mindset. They didn't possess the inner drive to overcome that little hurdle.
They blame the victim. The failure wasn't the system or the hidden risk. It was the investor's lack of psychological fortitude.
Exactly. The real investment risks, the things you can actually measure, quantify, and mitigate with proper work, they get dissolved, replaced entirely by personal development risks.
So the investors made responsible for the failure, not because they made a bad decision based on incomplete information, but because they weren't driven enough, positive enough, committed enough to magically overcome the impossible structural flaws that were deliberately hidden or downplayed in the first place.
It is the ultimate deflection. It protects the system, the promoters, from any accountability. It keeps the money flowing into the coaching program.
Okay, Solarian, we've traced the blueprint, we've analyzed the glittering, distracting facade. Now we need to pry open the crypts.
The dark places.
The deliberate omissions, the stuff they don't talk about, because this is where the core logical and financial failure of the whole persuasion architecture lies. These are the material realities systematically hidden beneath the cathedral's floorboards.
Right. The things buried under the promises of simplicity and guaranteed returns. Hashtag 3.1, claim simplicity versus actual complexity. And the biggest chasm, the place where the novice investor gets absolutely ruined, is between the claimed simplicity and the actual required complexity.
We have to move past the slogans here, past wealth without risk. Look at the actual work involved.
Let's start with due diligence.
Yeah.
We touched on it, but let's contrast the theater with the reality.
The simple claim, the theater, is...
Drive by and look. Maybe check Zillow. That's about it.
Okay, now, the actual mandatory requirement for any sane, responsible investor dealing with defaulted property.
It's exponentially more complex. It must include proper environmental assessments. You need to check for hidden hazards, asbestos, lead paint, leaking underground oil tanks, soil contamination, things that drive-by won't show.
What else?
Full title searches, going back decades sometimes. To verify the chain of ownership, uncover any claims, easements, judgments against the property or prior owners. This requires professionals.
Not just a quick online search.
No way. Then, detailed lien priority analysis. Understanding which debts get paid first if the property is sold. Is there an IRS lien that trumps your tax deed? A municipal utility lien, you have to know this.
And zoning.
Critical. Zoning compliance checks. Can the property actually be used for what you think it can be used for? Is it zoned residential, commercial, industrial? Are there restrictions? Again, a drive-by tells you none of this.
You know, that drive-by inspection, it won't detect that leaking underground storage tank from an old gas station that used to be on the lot.
Which could be a catastrophic liability, requiring maybe 6 figures in environmental cleanup costs, wipes out any potential profit instantly.
Or it won't reveal a historical easement running right through the middle of the property, making it impossible to build on or develop as you planned.
These aren't minor details you can just figure out later. They are potential total capital killers. And the coaching system systematically minimizes this risk. Why?
Because proper due diligence takes time, it takes effort, and crucially, it costs money. You need to pay for title reports, environmental surveys, legal reviews.
And that money spent up front immediately eats into those advertised high returns, doesn't it? It makes the whole proposition look less appealing, less simple.
Okay, what about the safety net? The idea that the redeemable deed protects you.
Another illusion. The safety net illusion. It's promoted as this ultimate protection. Hey, worst case, the owner redeems, you get your money back, plus that nice statutory interest rate. Win-win.
Sounds good, but the actual risk.
It's all tied up in municipal process risk.
Yeah.
And owner unpredictability. These redemption processes, handled by local government offices, they can be incredibly slow, bureaucratic, highly unpredictable.
So that redemption you're counting on might not happen quickly.
You face huge uncertainty regarding the timing. In theory, maybe the owner redeems in a few months. In reality, your capital could be tied up for 1 year, 3 years, maybe even 5 years in some jurisdictions, while the local government bureaucracy slowly churns, or while the owner tries, and maybe fails, to get the funds.
And if redemption ultimately fails, if the owner never comes up with the money,
then you're back to that complex, costly foreclosure or quiet title procedure we mentioned, which takes even more time and costs thousands more in legal fees.
So that promised 20% annual return gets heavily diluted by legal fees, by ongoing holding costs. You're paying property taxes and insurance the whole time you're waiting. And crucially,
the opportunity cost. Your capital's locked up, dead money, for years potentially. What else could you have done with it?
You're basically trading your liquid cash for this bundle of illiquid, risky legal uncertainty. And you're pinning your hopes on an unpredictable former owner, someone who already demonstrated they couldn't manage their finances, somehow materializing with full payment plus penalties and interest. It's a hope, not a strategy.
Exactly. And all this complexity feeds into dismantling the simple system myth.
The idea that the system works everywhere, just follow our steps.
Right. But the reality is massive, massive jurisdictional variance across the United States.
We really need to hammer this point home. It's not a subtle difference.
No. There are fundamental legal differences between a tax lien state and a tax deed state, for starters.
Explain that difference simply.
Okay. In a tax lien state, think Florida, Arizona, New Jersey, maybe you typically buy a lien certificate. You're essentially paying the owner's overdue taxes. Your money is generally safer because you don't own the property yet.
Yep.
You earn interest, often set by auction bid down rates, maybe 8% to 18%, if the owner doesn't pay you back within a set time.
Then you have the right to initiate foreclosure proceedings to take the property.
Correct. Contrast that with a tax deed state like Georgia, Texas in some ways. Here, the auction might seem more exciting. The potential reward seems higher. You might get that 20–30% redemption interest rate. Or you might even get the property itself relatively quickly if the owner doesn't redeem.
But the risk profile is totally different.
Totally different. You're instantly exposed to a much higher degree of complex legal processes. When you acquire a tax deed, you're essentially buying the property, but it's subject to the original owner's right to redeem it within a defined period, which can be lengthy. If they don't redeem, you still usually need to go through a legal process, foreclosure, or quiet title to get clear, insurable ownership.
So the legal structure, the risks, the procedures, the timelines, they are fundamentally different from state to state.
And even within states, you have something like 3,000 different counties and maybe 1,700 municipalities across the U.S., many with their own specific ordinances and ways of handling these sales and redemptions.
So the idea that one simple system taught in a webinar can possibly account for all that variance?
It's ludicrous. It's impossible. Relying on generic coaching advice when you're navigating thousands of pages of specialized, localized municipal and state law.
It's financial suicide. It really is. The simple system myth only sustains itself by completely ignoring the reality that you absolutely need specialized local legal counsel for almost every single unique transaction in this space, if you want to do it safely.
Which, of course, adds cost and complexity, undermining the pitch. Hashtag 3.2, the material risk catalog.
Okay, let's get specific now. Let's systematically catalog the concrete material risks that this persuasion architecture the cathedral tries to deny, downplay, or transfer onto your personal psychology. What's really lurking in the crypt?
Let's start with property-specific risks. We mentioned physical defects. Okay, that's somewhat obvious. But the hidden legal defects are often what really sink novice investors. Environmental contamination is a big one. Maybe the previous owner ran a business that polluted the soil. Or maybe there's asbestos or lead paint that wasn't disclosed. Cleanup costs can exceed the property value.
Title defects, too.
Huge. Clouded ownership. Maybe there was an error in a previous deed. Or an unrecorded heir has a claim. Maybe there are boundary disputes. Any cloud on the title makes the property difficult or impossible to sell or finance later.
And the scariest one, superior lien positions.
This terrifying for investors who don't understand it. Let's spell it out clearly for the listener. A superior lien means that some other entity, often the IRS for federal taxes, sometimes state environmental agencies, sometimes specific municipal utility districts, has a debt attached to the property that takes priority over your tax deed or tax lien and certificate, even if you paid the local property taxes.
So even if you win the property at the county tax auction,
you might inherit that pre-existing superior debt. Imagine you buy a property for, say, $50,000 at a tax sale. You think you wiped out all the previous debt because you paid the overdue property taxes?
seems logical.
But 6 months later, you get a notice. Turns out, the property has an outstanding $100,000 federal tax lien from the IRS, or maybe a massive state environmental cleanup lien.
And because it's a superior lien.
It wasn't wiped out by the local property tax sale. You now own a property worth maybe $60K, but it comes with a $100K anchor chain to it. Your expected profit just became a guaranteed massive loss, plus the headache of dealing with the IRS or the state.
That is a total capital killer. And it's something only rigorous due diligence, specifically checking for federal and state liens beyond just local property taxes, can uncover.
Exactly. Okay, beyond property-specific risks, there are process risks. Even if the property itself is clean, the legal process involved is its own potential nightmare.
We mentioned redemption timing uncertainty. Your capital locked up indefinitely.
Right, and the sheer cost and complexity of foreclosure procedures if redemption fails. Foreclosing on a non-redeemed tax deed isn't simple. It often requires that quiet title action.
Explain quiet title again.
It's basically a major lawsuit. You have to sue everyone who might possibly have a claim on the property. The former owner, their heirs, previous lien holders, sometimes even unknown parties, to get a court order declaring that you have clear, undisputed ownership against the whole world.
That sounds expensive and time-consuming.
It is. It can easily take many months, sometimes over a year, and cost many thousands, even tens of thousands of dollars in legal fees. per property.
And all these risks, property risks, process risks, are amplified by the market realities they obscure.
Like the high capital requirements. The pitch might make it sound like you can start with pocket change, using the B.R. Baker example. But the reality, especially at competitive auctions for decent properties.
You often need significant cash up front, right?
Yeah. The material suggests a minimum of $20,000 plus per auction is often necessary just to be competitive for anything decent. That's a high cash-intensive barrier to entry.
And which isn't always fully disclosed in the initial anyone can do this pitch.
No. And it immediately prices out the genuinely small, cautious investor the pitch often claims to serve. It forces investors who do participate to take on bigger risks to justify deploying that larger chunk of capital.
But the real operational killer, the day-to-day risk, is often liquidity constraints.
Explain that.
If the original owner doesn't redeem, which, again, happens frequently, you are stuck holding this non-redeemed, legally complex property.
Okay.
Now, how easy is it to sell that property quickly? A property that you know has a messy history, that likely required significant legal action just for you to get semi-clear title. Maybe it still has lingering clouds or perceived risks.
Not easy at all. It's difficult, time-consuming, and expensive to quickly sell a property like that. Potential buyers are wary. Getting title insurance might be harder or more expensive.
So your capital commitment period gets extended, indefinitely sometimes. Your money is stuck.
And that's where opportunity cost multiplies relentlessly. That $20,000 or $50,000 isn't just sitting there. It's stuck for maybe 3 years while you're paying legal fees, paying holding costs, and earning zero return.
That is the definition of illiquidity. The inability to convert your asset back into cash quickly without taking a massive loss. And tax deeds on non-redeemed properties are often extremely illiquid, the exact opposite of the quick flip or easy passive income narrative.
It's a trap disguised as an opportunity. Hashtag tag 3.3 due diligence imperatives, the real work.
Okay, so to stand strong against this onslaught of simplistic claims, the drive by and look mantra, we absolutely must enumerate the non-negotiable steps. The real work, the kind of due diligence that defines responsible investing in this incredibly risky space.
This is the complex, essential labor that the persuasion architecture is designed to make you ignore or transfer onto your own shoulders as a psychological failing if you miss something.
Let's build a counter checklist. What's first? Foundational.
Title examination. This is job one, your primary defense, and it goes way beyond just verifying the name of the current owner who defaulted.
What does a proper title examination involve?
It needs comprehensive searches. Identifying all prior liens, mortgages, judgments, mechanics liens, IRS liens, state liens, discovering any easements or covenants that restrict how the property can be used, and verifying the entire chain of ownership back through time, looking for breaks, errors, or potential clouds on the title.
Because a single missed lien, a single break in the chain,
Can render the property unsaleable, uninsurable, or subject to claims that wipe out your equity, years down the road even.
Okay, non-negotiable one. Professional title examination. What's two?
Physical inspection. And again, this mandate's going far beyond the superficial curb appeal check.
No more drive-bys.
Definitely not. You need a thorough structural assessment, preferably from a qualified independent inspector, not just your coach glancing at it, looking for foundation issues, roof problems, hidden water damage, outdated electrical or plumbing expensive fixes.
What else on the physical side?
Environmental compliance assessment, especially crucial for older properties or anything that might have had commercial use in the past. Checking for asbestos, lead paint, mold, soil issues, those underground tanks.
And zoning and compliance.
Yes. You must check the property's compliance against current local zoning codes and building regulations. If the property has an illegal addition or if it's zoned commercial but you bought it assuming you could rent it as residential, your entire investment plan just collapsed.
Okay. Title, physical inspection. Number three.
Financial analysis.
Yeah.
And this needs to be brutally honest and conservative. No wishful thinking. It
Easy.
requires accurate repair cost estimation, get real quotes from contractors if possible. And it's notoriously easy to underestimate rehab costs always add a hefty contingency buffer, maybe 25% or more, for the inevitable surprises hidden behind the walls.
What else on the financial side? Holding costs.
Crucially, you need a realistic projection of your holding costs over the entire potential holding period, which might be years if you face redemption delays or foreclosure litigation. This includes ongoing property taxes, potentially HOA fees, hazard insurance, liability insurance, utilities if necessary, and very importantly, budgeting for legal costs.
And comparing the potential profit to the risk and cost.
Yes, validating market comparables rigorously to avoid overpaying at auction, driven by that guaranteed return hype. What are actually comparable properties selling for in good condition? After all your costs, is the potential profit margin wide enough to justify the immense risk?
Okay. Title, physical, financial. What's the fourth pillar of real due diligence?
Legal review. This is absolutely non-negotiable. You cannot, must not rely on generic webinar tips or a coach's potentially conflicted advice when navigating complex, specific law.
You need professional legal counsel.
Mandatory professional consultation, specifically with an attorney experienced in real estate and tax sale law in that specific jurisdiction, county by county, state by state. They need to review the title work, advise on the specific redemption laws and timelines, explain the exact foreclosure or quiet title procedures and costs there, and clarify the complex tax implications of acquiring and potentially selling a defaulted property.
You have to acknowledge the limits of self-guided systems.
Absolutely.
Yeah.
Especially when the stakes are tens or hundreds of thousands of your dollars, and your potential opponent isn't just the former owner, but the intricacies of the legal system itself.
So failing to perform any one of these four essential steps, comprehensive title examination, thorough physical inspection, conservative financial analysis, and mandatory local legal review is basically like choosing to build your financial future on quicksand.
And the persuasion architecture, the cathedral we're deconstructing, is built specifically to convince you that these essential steps are just unnecessary complexities. Hurdles only faced by those who lack the proper entrepreneurial momentum or mindset, the dangerous lie. All right. We've done the deconstruction, we've seen the flawed blueprint, the deceptive pillars, the psychological tricks, the buried risks in the crypts. Now we need to take the final step, demolish this dangerous structure entirely, and propose a solid, reliable framework for building authentic value through risk-aware investment.
Right. Knock down the cathedral of thought built on illusion and replace it with something based on reality and sound principles. Hashtag 4.1 Persuasion Architecture Precedents, Lunaria's Connective Analysis. But first, it's really important to understand this blueprint we've just dissected, the one that obscures risk behind layers of emotional certainty and appealing narratives. It's not new. It's not unique to tax deeds.
You're saying this is a recurring pattern?
Absolutely. This cathedral architecture follows well-worn historical patterns of mass financial persuasion. It's like a scam template that just gets repurposed for different asset classes over time. The underlying mechanisms of manipulation are remarkably consistent.
Okay, give us some examples. Where have we seen this same machinery of denial and aspiration applied before?
Well, think back just over a decade. The 2008 global financial crisis. What was the dominant narrative?
Homeownership for all, the American dream. Housing prices only go up.
Exactly.
What?
A powerful, emotionally appealing narrative. And it was used to obscure fundamental underwriting standards. The system relied heavily on the emotional appeal of guaranteed home value appreciation. It systematically denied the basic risk of market downturns, of borrower default, especially with subprime loans.
The beautiful promise of accessible homeownership masked the structural flaw of bad debt bundled into complex securities no one understood.
Precisely. The emotional appeal justified reckless lending. Sound familiar? Okay, go back another decade, late 1990s.
The dot-com bubble, day trading mania.
Right. And what was the pitch then?
Democratized investing. Anyone can get rich quick trading tech stocks from their home computer. Be your own boss. Beat Wall Street.
The ultimate low-effort, high-reward promise, right? But what did that narrative mask?
Massive informational asymmetries. The huge gap between the tools, speed, information access, and capital available to institutional professionals versus the average retail day trader clicking away on their dial-up modem.
The pitch denied that asymmetry. Just like the tax deed pitch often denies the competitive and technical asymmetry between the novice attending a webinar and the 150 experienced bidders, lawyers, and fund managers potentially waiting at the actual auction.
It makes sense, and maybe the clearest, most direct parallel.
Has to be multi-level marketing. MLMs.
How so?
What's the core MLM pitch? It almost always uses the entrepreneurship frame. Be your own boss, achieve financial freedom, set your own hours, control your destiny.
A very appealing narrative, especially to people feeling stuck.
But what does that narrative typically disguise?
Usually, a pyramid-structured compensation model, where the vast majority of participants make little or no money from actually selling the product to end consumers. The real money, for those at the top, comes from recruitment, getting other people to pay joining fees, and buy inventory.
The pitch sells the dream of running your own successful business, the lifestyle, the flexibility, while obscuring the statistical reality that almost everyone involved actually loses money once you factor in fees and unsold inventory. Again, the beautiful narrative hides the flawed structure.
So the key takeaway here, for you listening, is recognizing this pattern.
It's the persistent abuse of information asymmetry
Yeah.
and the systematic denial or downplaying of risk. In every one of these historical cases, subprime mortgages, dot-com day trading, MLMs, and now these wealth without risk tax deed schemes, the promoter's profit thrives in that gap.
The gap between the beautiful story they promise and the often harsh reality they deliver. Shielded by emotional pressure, borrowed authority, and blaming the victim if things go wrong. Hashtag 4.2 superior investment philosophies. Solarian's contrast. Okay, so if we're demolishing this cathedral of risk denial, we need to rebuild on solid ground, on the bedrock of time-tested, genuinely risk-aware investment philosophies. We need principles that fundamentally reject the core premise of wealth without risk.
Where should we look for those principles?
Well, a classic starting point is value investing. The philosophy championed by figures like Benjamin Graham, Warren Buffett, its entire framework is built around acknowledging and managing risk.
How does it directly contradict the tax deed pitch?
Fundamentally, value investing insists on a margin of safety.
Define that.
A margin of safety means you only purchase an asset when its market price is significantly below your conservative calculation of its true intrinsic value. That gap, that buffer, is your explicit protection. Protection against errors in your own analysis, against unforeseen negative events, against market volatility.
It's the exact opposite of the tax deed pitch.
Which often encourages you to pay premium prices, sometimes bidding above the property's apparent market value, based on rosy projections of statutory returns or rental income that ignore the huge embedded risks and costs. Value investing seeks safety and price. This pitch seeks safety in unsubstantiated promises.
And value investing demands rigorous work, right?
Absolutely. It mandates deep fundamental analysis. It requires the investor to truly understand the underlying financial health, competitive position, and operational mechanics of the asset or business.
Which is the direct philosophical counterpoint to the drive-by inspection or relying on a coach's generic checklist.
The value investor embraces complexity. They expect to spend countless hours digging through financial statements, property records, legal documents. They don't try to deny complexity. They try to understand it better than the market does.
You have to accept that there might be 150 other bidders at that auction. Some of them definitely know more than you initially. Your job isn't to ignore them or hope they're wrong. Your job is to close that knowledge gap through superior, meticulous, independent analysis. Or walk away if you can't.
Another contrasting approach is evidence-based entrepreneurship, or just sound business practice.
How does that apply?
It requires systematic risk mapping. Before you deploy any significant capital, you identify, analyze, and plan mitigations for every possible point of failure you can foresee. What happens if redemption takes 3 years? What if title is clouded? What if rehab costs double? You plan for downside scenarios up front.
And it demands transparent metrics.
Yes. Real data, not anecdotes. Tracking actual returns, actual costs, actual timelines across multiple deals, which is the polar opposite of relying on survivorship bias and a few hand-picked, unverifiable success stories from the promoter. True due diligence involves acknowledging your potential disadvantages and working systematically to mitigate them.
Okay, so based on these sounder philosophies, how do we construct an authentic framework, a structure that actually supports sustainable value creation rather than just promising it? Where do we start?
It has to start with a risk-aware foundation, built on reality, not hope.
What does that look like in practice?
It means you insist on explicit risk enumeration. Before you even consider a deal, you list out every single potential risk you can identify. Title issues, liens, environmental, market downturn, zoning, legal delays, cost overruns, everything.
And then?
Systematic mitigation planning before any capital is deployed. For each identified risk, you need a written contingency plan. What specifically will you do if this risk materializes? How much will it cost? How long will it take?
We advise requiring a written, detailed failure plan for every single deal. No money moves until the disaster plan is finalized, detailing the exact process, estimated costs, and timelines if redemption fails, if a surprise superior lien pops up, if the property needs unexpected major repairs or environmental cleanup. If you can't stomach the failure plan, you don't do the deal.
Next, this framework demands evidence-based decision-making. Gut feelings and guru assurances are worthless.
Meaning documented processes.
Yes, building documented due diligence checklists your own. Customized based on jurisdiction and property type, establishing clear verification protocols for every critical piece of information.
So if you cannot verify the title history with an official title report, if you can't confirm zoning with the city planning department, if you can't get clear documentation on potential environmental issues,
You do not proceed, period.
the education itself must include mandatory in-depth training on the very things the persuasion architecture hides, understanding legal compliance nuances, lien prioritization rules, jurisdictional variance across counties and states, the hard stuff.
And finally, the foundation rests on realistic expectations. You have to ditch the guaranteed riches mindset.
Authentic investment operates with probabilistic thinking. You forecast potential outcomes as a range, not a certainty.
You must explicitly plan for failure scenarios, not just acknowledge they could happen, but plan what you will do when they happen. And you have to accept deep down that success is absolutely not guaranteed in any venture involving risk, especially this one.
You need to calculate the potential cost of failure into your required margin of safety. If the absolute best-case scenario promises a $40,000 profit, but a realistic worst-case scenario involves losing $15,000 to legal fees and holding costs plus 3 years of your time.
Your effective margin of safety might be razor thin, or even negative. And you have to act accordingly, demand a much lower entry price, or more likely, just walk away from that deal. It doesn't meet the risk-reward criteria. Hashtag tag 4.4 structural reinforcement protection protocols.
Okay, we have the foundation. Risk-aware, evidence-based, transparent, realistic. Now, what specific structural reinforcements do we add to protect the investor? Concrete protocols to guard against the pitfalls hidden in those crypts we exposed earlier.
Let's talk financial safeguards first. Non-negotiables.
Number 1.
Title insurance. For every single transaction involving property acquisition, it's not optional. It's a mandatory safeguard. It's your primary financial buffer against those hidden title defects, breaks in the chain of ownership, or unknown prior liens that the initial searches might have missed.
Don't let anyone convince you it's an unnecessary expense in this space. It's critical protection.
Absolutely. Second financial safeguard, maintains significant liquidity reserves. Cash buffers. If the deal itself requires, say, $50,000 in capital for the purchase and estimated rehab, you must have additional readily accessible funds set aside specifically for unforeseen costs. Maybe another 30%, so $15,000 in this example, for surprise legal action, unexpected structural repairs that pop up mid-rehab, or extended holding costs if the sale takes much longer than planned.
The rule is never, ever commit 100% of your available investment capital to a single highly illiquid asset like a tax deed property. You need reserves to handle the inevitable bumps.
And third, rigorous opportunity cost analysis. Before you tie up that $50,000 plus reserves in this complex illiquid venture for potentially 3 years.
You have to ask, what else could that capital achieve? What's the realistic risk-adjusted annual return it could likely generate in a safer, more liquid investment over that same period? Maybe diversified stocks, bonds, even just high-yield savings.
The potential profit from the tax deed deal must substantially outweigh that opportunity cost, plus a significant premium to compensate you for the vastly higher risk, complexity, and illiquidity you're taking on.
Yeah.
If it doesn't clear that high hurdle, it's mathematically a bad deal, even if it looks profitable in isolation.
Okay. Financial reinforcements. Title insurance, liquidity reserves, opportunity cost analysis. What about the legal and compliance side?
Mandatory structural reinforcement here is professional legal and compliance expertise. We've said it before, but it bears repeating. This is not optional. It is mandatory.
Specifically, local expertise.
Yes. You need professional legal consultation from lawyers specializing in real estate and tax sale law in the specific county and state where the property is located. They're essential for mapping the exact jurisdictional requirements, interpreting local statutes, guiding you through the correct procedures.
You have to acknowledge the severe limitations of generic self-guided systems when dealing with the complexities and nuances of local law.
You simply cannot afford to be an amateur playing in a professional litigation environment. And that is precisely where you land the moment a property owner disputes redemption, or you need to pursue foreclosure, or a surprise lien holder shows up. You need professional representation immediately.
So the authentic path to wealth generation, if it exists in this space at all, is built completely differently.
It's built on transparent risk acknowledgement, on systematic complexity management, on rigorous independent verification. It is absolutely not built on a seductive narrative of effortless certainty or magical government guarantees or following a guru's secret system.
It's hard work. It requires diligence, skepticism, and significant resources. But the resulting foundation, if you build it right,
Is solid, it's defensible, and it's impervious to the kind of persuasive manipulation embedded in the Wealth Without Risk Cathedral.
and that's our deep dive for this week.
Remember, the most dangerous illusion is the one you don't know you're in.
But now you know. So here's our question for you. Where will you see this same cathedral of persuasion? A beautiful structure built on shaky foundations. In the next piece of financial advice you encounter. Once you know the architecture, you can't unsee it.
Let us know in the comments. Question the narrative. Deconstruct the dogma. See the system.
We'll see you next time. Stay skeptical. Thank you for joining us.